Management Accounting C370 Unit 2 Summary. When understanding the product or sales mix, we make use of one of the key analysis, that is the cost volume profit analysis, or we also call it the CVP analysis. As you can see, the diagram shows the CVP analysis, where you can see that the total cost line is an upward sloping line which starts from $200,000 according to this example considered. The key reason behind this is that the green line denotes the fixed cost, that is, even with zero production there will be a cost that is incurred which is fixed throughout the relevant range of output. And in addition to that, for each unit that you produce, you got to incur certain costs which will be the variable cost. So the total combination of the fixed cost and the variable cost makes the total cost line. And then we have the sales line, which is the total revenue line. That starts from zero, because the moment you sell a unit only you can earn money. And the situation where the total cost is equal to the total revenue will be considered the break-even point, and we will be looking at break-even point in detail later. So one of the methods used to understand the relationship between profit, cost, and sales is cost volume profit analysis. Considering the assumptions of CVP analysis, according to Collier 2015, the assumptions of CVP analysis are the key weaknesses of CVP analysis too. When it comes to these assumptions, the first assumption is that there is a linear relationship. When it comes to this linear relationships assumption, it's because of this assumption that economies and diseconomies of scale are ignored, because economies of scale is when the cost or the average cost reduce when the output increases. But with linear relationship assumption, irrespective of the change in output or irrespective of the increase in output, the unit cost will remain the same, meaning that the average cost will remain the same. But this is not the practical situation. It is same for the case of revenue also. Then constant cost behavior within a relevant range of output is the second key assumption. So we assume that the cost is constant. It does not increase or decrease, but practically there can be inflationary situations. Cost of production may increase due to taxes, etc. So these changes are not considered. And there is also the assumption that volume is the only factor that changes prices and variable cost. And there is a constant single product or service, or a single product or service mix. But practically it's not the case. Most of the businesses, they have multiple products or multiple product mixes. And also the CVP analysis assumes that all costs can be fixed or variable. But practically we have semi-variable costs, stepped fixed costs, and they assume that fixed costs remain unchanged, but practically fixed costs vary with the items, the type of the item that is produced, with the product complexity, with these factors. Considering about the break-even volume is equal to the division of fixed cost and the contribution per unit. So when it comes to this break-even point, it can be calculated in value or in units. When it comes to calculating it in value, we can calculate it using fixed cost divided by the profit volume ratio, or we can also use an alternative, which is the profit volume ratio is being equal to 1 minus the marginal cost over the selling price per unit. Considering the BEP in units is the first equation that we considered. So when it comes to this, the first equation, we know about fixed cost, but what's contribution per unit? Actually, contribution per unit or unit contribution is the gross margin in financial accounting. It is the amount of the selling price that contributes to cover the fixed cost and to achieve profits. With CVP analysis, profit can be calculated using a certain equation, which is equal to net profit is equal to the selling price per unit multiplied by the number of units sold minus the fixed cost plus the total variable cost. Considering about the importance of CVP analysis, CVP analysis permits the application of sensitivity analysis. Sensitivity analysis is an approach to understand how changes in one variable affect other variables. Not only that, CVP analysis helps in making decisions about pricing and volume based on an understanding of the business cost structure. And often management accountants make decisions based on contribution because fixed costs are assumed to remain fixed and can therefore be excluded. And for decision-making purposes, only relevant costs should be considered, whereas in many short-term decisions, fixed costs are irrelevant because they will anyway be incurred. So in these cases, in these short-term decision-making situations, the marginal cost will be equal to the variable cost. However, when the level of fixed costs change, that is, in the long run, the marginal cost will be equal to the variable cost plus the step fixed cost. And moving on to CIM 2017's arguments, there are several decisions that are made using marginal cost. For example, whether to accept or reject special contracts, then to determine the most efficient use of resources, to decide whether to produce it in-house or to outsource it, to decide whether to close or continue that particular department of a business or product. To make this kind of decisions, marginal cost is used. And considering at the last option, to decide whether we are going to continue a product or close it, considering the last option regarding closing or continuing the particular product or department, to make the decisions on this kind of thing, we need to consider the profitability of that particular market segment. Considering about margin of safety, another benefit of using CVP analysis is that we are able to identify the margin of safety, which is the difference between the anticipated and break-even levels of activity. Considering the margin of safety percentage will be the difference between expected and break-even sales over expected sales as a percentage, that is multiplied by 100. So the lower the margin of safety, the higher the risk will be, and vice versa. Considering about the sales mix and break-even with multiple products, a business that achieves its sales targets may not achieve its profit target if the sales mix varies and profitability varies between products. So it's very important to identify what is the correct sales mix and what kind of products should be included in it. Considering about operating leverage is a mix of fixed and variable costs in a business, and the ability to use its fixed cost to generate contribution is known as operating leverage. So using fixed cost and variable cost in a particular combination and using the fixed cost portion out of it to generate the contribution is particularly the operating leverage. So a high operating leverage means high fixed cost and low variable cost, which indicates that there will be high contribution margin per unit. Considering about achievement of a target profit, CVP analysis helps us to understand how to achieve a target profit, or what is the profit volume, what is the quantity of goods that we need to produce in order to achieve this target profit. So to identify the volume of goods we need to produce in order to achieve this target profit, the fixed cost plus target profit, that total should be divided by the contribution per unit.